economist.
That's what I was like. See?
No, global head emerging markets and commodities research.
Yeah, that's fine
What
too.
economist? She doesn't understand. She's not an economist.
Yeah. I mean, I do commodities too, so great fun.
Look at his face.
Okay, shall we begin?
It's live.
Yeah. Ready to go? Okay. Good evening, everyone. India's Finance Minister Nirmala Sitharaman has promised India a never-before budget. And indeed, she is crafting her budget against the backdrop of never-before circumstances. The Indian economy was going through a slowdown even before the pandemic hit and India went into a lockdown, following which we had a never-before unprecedented contraction of the GDP by 23%. And even as the economy has slowly begun to limp back into a phase of recovery, India today is in a technical recession. The challenges before the 21 budget are significant, and we have with us two of India's greatest, most provocative economic minds to discuss both the macroeconomic challenges that the finance minister confronts as she prepares and presents her budget to the country, as well as more broadly, the big economic challenges that we confront as India's economy hits back into recovery and hopefully eventually back onto a steady pathway of growth. I'm joined today by Jahangir Aziz, Chief Economist, Emerging Markets of JP Morgan, and Rathin Roy, who is a visiting fellow at the Center for Policy Research and also managing director of the ODI, the Overseas Development Institute. Thanks both of you for joining us today, and thanks to the audience for being here this evening in Delhi and morning, afternoon, wherever else everyone is, for what promises to be a provocative and exciting conversation, even as the economy can somewhat be, is somewhat depressing. But let me start, Jahangir, by asking you to talk to us about how you see the current macro environment and the big challenges that the FM confronts as she thinks through how to deal with the pressures of COVID, as well as particularly around the kind of dynamic of recovery we're beginning to see, where listed firms seem to be putting us back onto some path of recovery, but small and medium enterprises, which usually spearhead recoveries, are not doing very well, and unemployment remains a significant challenge.
First of all, thanks, Yamini, for the invitation. Rathin, glad to see you again. So let me just start with a bit of a background in terms of how we are looking at this recovery. So all this pandemic. So I think one of the biggest challenges that I think policymakers across emerging markets, including India, faced was the following: that this pandemic was unlike any other emerging market crisis that we've ever seen. So we go back to the 1980s onwards. You have the Latin American debt crisis. Then in the 1995, you had the peso crisis. 97, you had the Asian financial crisis. 99, the Russian crisis. In between all of that, India had this debt crisis, 81, 82, 91, 92, another crisis. And in 2013, a whole bunch of the countries, including India, went into mini crisis mode with the taper tantrum, if you remember. Now, if you look at the pattern in all of these crises, it's the same pattern. 2-3 years before the crisis, you have this very loose monetary, very loose fiscal policy that goes and pushes up growth, overheats the economy, inflation spikes, balance sheets of households, of SMEs, of corporates become completely bloated. And then suddenly, and all of this is financed by some, in a large amount of capital flows that comes into these economies. And then suddenly, foreign investors particularly, start with the reassesses the risks to the economy, and all of a sudden asset prices collapses. And then the economy goes into an economic crisis to adjust to that financial crisis. So it's the financial crisis that triggers a prolonged period of adjustment in the economy, where the economy has to go through, the pains of restructuring their balance sheets, and in all of these crises, typically you have the same policy response. The economy has gone into a financial crisis, and all policies have to tighten. And even if, for example, the crisis was caused not by the government bloating up its budget, let's say the Asian crisis, right, but the private sector, even then, fiscal policy has to play the role of, supporting the economy. But the support to the economy is trying to establish financial stability first, macroeconomic stability next, and then think about the recovery. So in all of these crises, emerging markets have been used to tighten in the face of a crisis. This crisis was completely different. There was no financial crisis. You spoke about it. India's growth rate, or emerging markets growth rate everywhere across the emerging market world, was actually slowing. There was no sign of overheating anywhere in the world. We were looking at inflation, going below our 4% targets in the eve of the crisis. And balance sheets nowhere in the world, maybe in China, if you think about China in terms of, its debt, was the only place where the balance sheets looked, fragile. Nowhere else. There was hardly any bank credit growth that had been taking place in the past 5 years. So this crisis wasn't the same sequence. Instead, the sequence was turned around. You had the economic crisis caused by something which has nothing to do with policy. It was a pandemic. And the question is, should emerging markets behave in the same way, or the policy responses in such a crisis be the same as the ones that we have gone through the previous crises? And I think that was the challenge. And I think that different countries picked up on this difference between this current crisis and the past crisis at some point in time in that entire period. I think the central bankers across the emerging market world picked up the first, that this wasn't the same as the previous crisis. So, if you think about, go back to February, March, and capital flows were receding, there was a massive amount of outflows taking place, exchange rates were all depreciating, yet across the board, every emerging market country, central banks cut interest rates, something that we never do. And I would say that large part of that was provided, the cover for that was provided by the Fed's action, where the Fed, almost 2 weeks into the crisis, provided the kind of unconventional, monetary policy support that no one really thought it would. It had been doing balance sheet expansion for about 10 years before that. And when everyone thought that the Fed didn't really have any space, the Fed changes its instrument that says we will now move from quantitative easing, providing, buying, for example, government bonds, to buying corporate sector bonds, to credit support. So I think a lot of that space, intellectual space at least, was provided by Fed's action. But the central banks moved first. But the problem was that central banks can only provide minimal amount of support in a period where you are going to see 25%, 30% declines in growth rates. That's essentially what the pandemic meant, because everything was being locked down. And I think that the governments across the world took its own sweet time to respond to it. And I think the Indian government, in turning to India, for example, till about November, we didn't really see any kind of serious material support coming from the economy, from the government, for that entire 6 months period. Some countries, of course, did it better than others. Brazil, for example, which, by the way, has, I'm sure that Rathin and I will talk about, the fiscal space available to do any kind of support. I'm sure you're going to ask me that question. But, Brazil's fiscal space was even more constrained. And Brazil provided 8% of GDP in actual COVID-19 related support. So different countries did different things. Mexico, for example, went India's way, said nothing doing. We are not providing any real support at all. The total amount of support in Mexico is just about the same as that in India. So I think that the problem that has arisen, and I think this is where I think fundamentally this pandemic policy response and the recovery path, which will depend on the policy response, is very different from what we are used to, is that we are asking emerging market countries to do something they've never done before. We are asking them to ease in a crisis. And this has made not just emerging market policymakers, but it's also made emerging market, market participants, the capital market, the financial market, very, very uneasy. Why is that unease? Because we do know that emerging markets have a very checkered history of fiscal discipline, of monetary policy discipline. This has been earned, for the last 20 years, bringing in institutions like, inflation targeting, fiscal responsibility acts. So you had to bring in the legislature to tie the hands of emerging market policymakers to go down the path of straight and narrow. And the question was, and the question still is, that if you allow or if you let emerging market policymakers do what they, normally are being told for the last 20 years not to do, which is to give up fiscal discipline, give up monetary policy discipline, will they ever go back to that path of straight and narrow when the economy recovers? Or is this the thin end of the wedge where, this is the space that has been created, there's an opportunity, or the space was created, they took the space, and then none of these countries ever go back to fiscal discipline. And I think the conversation around policy is almost identical in all of these emerging market countries. Now, I'm exaggerating a bit. Emerging market countries are two kinds these days. One kind are the ones that are, low inflation, low growth, but very large amount of current account surpluses. You talk about the Koreas and the East European and the Central European countries, etc. And then there are these 5 or 6 countries which haven't really changed very much since the time of the 2013 crisis, which we in the financial market parlance are called the high yielders, which have very large debt, current account deficits, large fiscal deficits, and the usual suspects. It's South Africa, the Indonesias, Indias, Brazils, Mexicos of the world, and unfortunately, these are the largest emerging markets outside of China. But I think the conversation is exactly the same. That we have to look forward to not just how the pandemic behaves, which again depends very much critically on the public health system of each country's, depends on how much vaccination they have, how the vaccination rollout is taking place. On one hand, a natural recovery taking place because of that. And what does policy do now in January of 2021, after having eased in varying degrees in 2020? Mm-hmm. Should they go back to that path of fiscal discipline, to the path of straight and narrow? Because otherwise, confidence in these economies will be shaken. Or do they continue to keep supporting the economy? Because there is no, we are talking about recovery taking place, but there isn't any real recovery that has actually taken place in most of these economies. So I think that's sort of the quandary we are in, and that's where I think India's budget, just like Brazil's budget or South Africa's budget, is being debated exactly in that same common, set of constraints and environment. But let me stop here, and then, we'll go ahead.
Thanks, Jahangir. I think you've got to the heart of the issue. But Rathin, let me ask you this. The Indian government chose, in fact, to maintain at least some veneer of fiscal discipline, and often argued that fiscal discipline was one of the reasons why it chose not to be as generous as you, Jahangir, and many others, myself included, have been arguing, given the reality of the pandemic. In fact, this is perhaps one of those rare moments where all of you fiscal hawks talk about income support, and people like me who've been focusing on social policy and I've been banging on about more social safety nets are fighting like Bombay wants income support, yet we didn't. And there is a political economy around the kinds of choices we made at the heart of the lockdown and the pandemic. And that political economy is also likely to shape the kinds of fiscal discipline choices that we are going to make around how we respond month now in FY21, given that we are on some path of recovery. And monetary policy seems to have more or less done all that it could to get us at least to where we are. So your thoughts on the political economy of the macroeconomic choices we've made thus far, and what are going to be the big political economy drivers for decisions that we need to take in a few weeks from now?
Okay. Well, it's nice seeing you, Jahangir, and thank you, Yamini, my first event as a CPR fellow. Let me take you all back to, as Jahangir did briefly, to 2019 February. And let me look at the state of the macroeconomy then. What was the state of the macroeconomy? Growth had been falling consistently for 4 years running. Investment growth was almost zero, if not negative. Despite pious statements that I've been hearing since I was in short trousers, exports were not an engine of growth. That factoid has stayed true all my life. Mobile phones have come, but exports are not an engine of growth. Arnab Goswami came, but exports are not an engine of growth. I came back to India and exports are not an engine of growth. So I want you to focus on what is and not what ought to have been. We had inflation targeting, but we had absolutely no idea whether the instrument used for inflation targeting, which is effectively to create an administered price for capital, which is the wholesale interest rate, right? Not for labor, just for capital. That's what we have done with inflation targeting. We have created an administered price for capital. Whether that instrument was correlated with low inflation rather than, for example, just the fact we were not growing as fast, and that consumption effectively was the only driver of growth. This state of affairs was compounded by the fact that it corresponded with a situation where the government of India's ability to maintain at least a constant tax GDP ratio spectacularly decelerated. And in the budget of 2019, when you stripped away all the lies, which I did, I'm glad I did that, the revenue GDP ratio was the same as it was in 1991-92. The point was not that. The point was nobody in government had any idea why this was so. People like our current esteemed executive director of the IMF were in fact arguing that tax buoyancies have gone up. I'm very troubled about this because today some people have been saying that again. But tax buoyancies in fact had been going down and we had no idea why. The government of India's ability to do what a income poor but asset rich entity does, any entity. What do you do if you're not earning income but you have assets? You try and monetize those. Privatization, disinvestment. Failed spectacularly. In none of these years was the disinvestment target met. So on the revenue side, you had already fiscal constraints. On the expenditure side, you began cutting expenditure, but when you added the math up, the government of India had been consistently missing its fiscal deficit targets year after year anyway. So what you had there was a very weak state at the dawn of COVID, and a weakening economy at the dawn of COVID, and a monetary policy which observed low inflation but had no idea whether that low inflation was, or that particular target was either desirable for the economy or whether indeed the instrument used was the cause of low inflation. There are many other possible causes. And the usual, on the current account front, depreciating exchange rate, which is fine, but the balance of trades, deficit, chugging along. COVID comes and all these facts upend. Fiscal policy obviously remains weak, but no one's bothered about that because the question not is now how much you collect in terms of taxes, but how much you can mobilize to spend. Monetary policy, I don't know how to describe it politely. Let me try and be as polite as I can. Pontificates in the pronouncements of that so-called monetary policy, not so-called, it was the Monetary Policy Committee, right? Talking about numbers and prints and wins and trends and making generic statements. But broadly speaking, they tried to lower interest rates and then they put them on hold and nothing happened. On the balance of trade front, our economy shrunk, we exported less, but we imported even less, as a consequence of which, after a long time, we actually ran a small balance of trade surplus, right? It is reversing now, but we did for a while. So the entire instrumentation of the Indian economy had upended. Now, if this had happened with a competent economic administration, which had a medium-term plan for India, which was not the case then and is not the case now, then you could have said, okay, now that these facts have changed, how do I change my mind and change policy? And I think one of the reasons why the government of India was unable to use the fiscal instrumentation at its disposal was that it was already weak and it had no idea, actually, how to set about an expansionary fiscal policy. It wasn't that Barkis was unwilling, to quote Oliver Twist. That is, in a sense, that was irrelevant in April and May and June. Because I and many others had given evidence repeatedly in writing to the government of India that there was no problem mobilizing up to 10 to 12% of GDP, as long as you knew what to spend it on and that spending was effective. If you knew how to protect wages, and if you knew how to protect capital, and you made sure that money was not diverted, as so often happens in India, to other purposes, then there was no constraint to spending more. But the government of India had neither the capacity nor the confidence that it would be able to complete, finish, and execute an expansionary spending program of this magnitude. It is difficult to cut. It is also very difficult to spend very quickly, very fast, when your instrumentation is weak. Therefore, they turned to monetary policy, where the obvious thing that they could do politically. Sorry, let me go back. There was one thing they could have done right from the beginning, which is to have acknowledged that there are many governments in India, one of which has been rendered sclerotic, which is the third tier, and therefore not much action there, but they could have taken some. But most important, there were the states who were in a reasonable fiscal position. And the government of India, therefore, could have asked the states to engage in expansionary fiscal policies. But that would have meant giving credit to the states, and that is not the current policy of the government of India politically. All credit must flow to the Sultanate, to that hill behind us. All credit for everything, from the launch of a satellite to a vaccination, must flow straight back to that hill from which we are ruled. No credit may be shared at the decentralized level. That means, therefore, that the only option you had in fiscal policy was nullified politically, since you asked me for political economy. Right. Monetary policy is entirely at the central government's disposal. Nobody else can get credit. People don't understand it. There's no scrutiny. So what you saw was a major expansion in liquidity, and in many instances, practically a guarantee to people that if you borrow and you perhaps default, we'll be nice to you. These are special circumstances. And we'll take care of the bank balance sheets, etc. later. So you see a massive liquidity expansion. A large chunk of it then is passed on to the states by saying that, I'm sorry we couldn't collect taxes, so we can't give you what we agreed in terms of GST compensation. But here, you can borrow more. Okay? So here's some more money, borrow more. So essentially, the central bank expanded liquidity on the understanding that if the economy is shrinking, if you go by the logic of inflation targeting, then you ought not to see inflation as a consequence. That, it's early days, but we are seeing that that assumption was possibly wrong, because we are seeing inflation. We are also seeing what I think Jahangir's colleagues, Sajid, has correctly called a profit-led recovery, where essentially people who are asset holders and able to avail this liquidity are using it to protect, not to invest and not to enhance business, but to protect their profits by essentially staying afloat financially while cutting the size of operations, which contribute to decline in growth, and therefore cutting the inputs they need to buy, including labor inputs, which is why wages are falling. So in a sense, India's story is much worse. I don't know what happened in Mexico than Jahangir describes, because you had a fiscal policy that is dysfunctional, and going to the budget, I believe it will continue to be dysfunctional, because there is very little the government of India can spend significantly more on than it already does. It can only spend more on Narega. It can only spend more on perhaps putting more money into more kinds of people's bank accounts. And it can perhaps make sure that they at least spend enough on getting everyone vaccinated. It has been 7 months since we had COVID. I have not seen any increase in the most urgent infrastructure necessary to deal with the health pandemic, which is health infrastructure. I am seeing infrastructure being repurposed for that. but I'm not seeing any enhancement in infrastructure like I've seen in China or in many OECD countries. I say this to you because I therefore argue that to say that the government should spend more on capital expenditure is a facile statement to make, because the government of India does not have the capacity to spend more on capital expenditure. The government of India wished to privatize the LIC. It does not have the capacity to monetize its own assets fast enough. It only appointed the transactions advisor to LIC in November, when the announcement that LIC would be privatized or disinvested was made in March. Those are the timelines you're talking about. And those are the timelines I've seen all my life. Public spending on infrastructure does not complete and finish, which is in fact why we went down the PPP route. That was not good enough. It spoiled many balance sheets. So I'm afraid infrastructure spending has become a bit like Gandhi's comment on Western civilization in the Indian case. It would be a very good idea. But to commit money to infrastructure and not deploy it well is like committing money to buying 100 Rafales and ending up with 15 in an Indochina war. It is a misuse of public money. So I would look at fiscal prudence challenge in this budget very much as, what guarantees is the finance minister going to give me politically that, having decided not to give money to the states, having decided not to use other agents of execution, that public money will not be put to purposes which it is not within the government's capacity to execute, complete and finish. It's a very serious problem. It's a problem that Yamini, I've been arguing for in education. I do not believe the government of India, or even many state governments, would know what to do with the money if I gave them 2% of GDP extra on education tomorrow. There is simply no battle plan. On the monetary policy side, we have a new monetary policy committee, and we are already getting warnings from the RBI that the financial system's fragility has increased through COVID. So the liquidity party is going to end probably with either the taxpayer or the government of India's asset base paying for the increased fragility going forward. On the balance of payments front, we're a price taker, so it would be prudent and wise not to take circumstances such as we are seeing as a given, and not to flirt with the sort of, if you like, party chat room idea that countries are getting more inward looking and that less trade is going to happen, because that is not the reason why you engage in trade if you're an emerging economy. You engage with that to be at the cutting edge of buying and selling stuff that people want to produce and consume. So the second macroeconomic challenge, therefore, is that your normal, wish list for growth is not happening. China may not be everyone's favorite destination today, but if I were an investor boy, I would go to Vietnam. I would go to Bangladesh. Why would I come here? Why would I even come here? You don't even have an IBC, right? We are not competitive with many countries who can, at least in the first and second rounds, absorb a lot of replacement for Chinese economic activity, if so desired. Don't look at Mexico and Brazil, look at our neighborhood. Plenty of countries. So that's not going to fire your engines in the short term. Infra investment, domestic investment is a good idea, but like Western civilization, is not going to fire your engines. Consumption is not going to fire your engines. Therefore, the only option you have is to fire the demand engine by changing the output composition of demand away from, sorry to sound like a stuck record to some of you, what the top 10 to 15% of the population have been consuming to what the rest have been consuming, but that requires structural policies and money to fund those. Until you get that change in macroeconomic stance, you are going to remain, I'm afraid, one of a macroeconomy that is performing well below potential.
Jahangir, too tempting not to ask you to respond to that in two ways. Rathin provokes appropriately as he was tasked to do as well. I think, on the one hand, Rathin argues that, if I interpret him correctly, that our own state capacity constraints constrained the Indian economy's ability to be expansive in the moment of crises. It'll be interesting to hear from you a little bit more about what are the consequences of that, particularly in the light of the nature of the sort of profit-led recovery that we are beginning to see, and what are the long-term structural challenges that will bring for us. He also argues that we've sort of hit the limits of monetary policy. and the liquidity party is on its way over, and the inflation party is about to begin, or actually has already begun and is going to become more significant. And then of course there's a federal issue as well. How do we have an expansionist policy if we don't know what level of government should be spending what? But all of this, and ultimately the answer lies in structural changes to demand composition. All of this is fine at one level for the long term, but we still do have the short-term immediate challenge of a pandemic that is perhaps on its way out, but an economic recession that we absolutely have to be able to climb out of. So where do we go from here?
Can I ask Jahangir?
Of course.
While here, Jahangir, could you sort of give us your views, or whether you indeed think that the Indian economy is in recession? Thanks.
Sure. So I was going to start with that question, Yamini, because I think before even we go into what are the policy choices and what the recovery path, we need to at least agree among ourselves what is the growth path in India.
Yeah.
And the problem that has been, apart from the methodological issues that has plagued the new CSO estimates, and I'm not even going there because that will take another session just to discuss that. CSO, unlike most of its peers in emerging markets, and definitely unlike any developed market, continues to give us growth rates which are on a year-on-year basis. So if you look at what happened in the second quarter of 2020, which is the first quarter of the fiscal year, CSO comes up with a number, India's growth rate on a year-on-year basis went down by 23.9%, 24%. And then in the third quarter of calendar year, it went down to 7.5%. And therefore, I think it was an RBI note, but then everybody latched onto it and said, well, therefore India is in a technical recession. The problem is when we define technical recessions, we don't really talk about year-on-year growth rate. And there is a huge problem with year-on-year growth rate. If I do year-on-year growth rate, I really need to know what happened the year before that in that particular quarter.
Yeah.
And that has been a problem that economists have known at least for 100 years, and they've had solutions almost for 100 years. And almost all statistical organizations across the globe, almost all, have been shifting away from that and providing what should be the right growth numbers, which is a quarter-on-quarter growth rate. At least for the last 30 years, we don't do it. Since our CSO doesn't do it, we are sort of left to our own devices, and therefore we are forced to come up with our own estimates. So if you estimate the seasonally adjusted quarter-on-quarter growth rate, then in the second quarter, the first quarter of fiscal year 21, in that second quarter, when year-on-year growth rate fell by 23.9%, in reality, it fell by 25% compared to the first quarter of that year. Mm-hmm. In the second quarter, and this is where second quarter of the fiscal year, this is where the narrative becomes problematic. You're telling us that India's growth slowed even further by 7.5%. In reality, if you looked around at that point in time, you had much greater mobility. People were moving out, people were doing business, nothing compared to what was normal, but there was a recovery taking place in the streets. However, your data didn't show it, and that was because you were looking at these year-on-year growth numbers. If you look at the quarter-on-quarter growth numbers, then in the third quarter of calendar year, the second quarter of the fiscal year, India grew by 21%. And so there is no technical recession in India. And the debate about that there is a technical recession, therefore we need to do certain things, is very misleading, because it does not respect the recovery that is actually taking place, despite the fact, which Rathin and I and you have all agreed, despite the fact that there has been very little of government spending or government support to the economy. Mm. So I think, in the first place, I think we need to understand that there is a recovery taking place. The problem with that, and that recovery is strong enough for, at least for us, JP Morgan, to say that on a year, for the entire year, fiscal year 21, ending in March of 21, India is probably going to decline, growth is going to decline by about 6.5%. We are the most optimistic in the street, and that optimism is based on the hope that what happened in the month of November in terms of higher expenditures by the government continues through the rest of the fiscal year.
You want to comment on that?
Yeah, I agree with you.
Rathin, do you want to just quickly comment on that?
No, I agree with him. I just want to
definition of-
explain to your listeners that what Jahangir is saying is that the Indian economy tanked very badly in the second quarter of the calendar year. But it recovered from that tanking in the third quarter.
Yeah.
And therefore, you'd have to do worse than the second quarter and the third quarter to be in recession. Therefore, it's not in recession. But when you do the math, at the end of the year, you'll still be smaller than you were in 2019 March.
You'll be
Yeah.
You'll be 6.5% lower than you were in.
I think 8, but that's fine. And I don't think you're going to make that up by March 2022 either. So basically, you've lost 2 years as a consequence of the recession.
Right. So I think that is where the debate needs to be. So we have in 2022, we have India growing by an astonishing 13.5%. And again, we can talk about that. Again, it's based on our view or hope that the government continues to provide sufficient amount of support to the economy and bad things don't happen. And I'll come to that. Right. But even if India grows at 13.5%, so we are the highest in the street in terms of 22 recovery, even if that happens by the end of 22, so by the end of March of 22, if you look at the level of GDP will still be about 5 percentage points lower than its pre-pandemic path. And the level of GDP matters because the level of income matters. You can go to your loan officer and you can come up with the best stories about how great your income is going to grow in the next 5 years. You will still not get a loan. The only way you get a loan is to show what is your level of income. And I think that if you look at that arithmetic, then on average, India will lose about $200 odd billion of income in fiscal year 21, another $200 billion of income in fiscal year 22. Now, this is the average income loss. This is not the overall income loss, which goes back to your point that you made and point that, Sajid has been making quite some time, that if you look at the composition of this income, and you look at RBI's report on, let's say, the listed companies in the third quarter of calendar year, when India on a year-on-year basis fell by $7.5, the listed companies' profits grew by 30%. In real terms, it probably grew about 20-25%. So if the economy's overall income fell by 7.5%, and the listed companies' income grew by 25%, 20%, then the remainder of the economy, which is made up of SMEs and households, must have fallen larger than 20% in order to make the average -7. This is just arithmetic.
Yeah.
So the $200 billion loss for 21 and 22 on average that we're talking about for 24 months will fall disproportionately on households and SMEs. And it is...
May I just put that, Jahangir?
Yeah.
In 2 sentences, you're going to see a smaller economy and you're going to see a far more unequal economy.
That's the hard
And the best benefit of having a smaller and more unequal economy is one that's going to further weaken the government's fiscal position.
So those are concerns, I think, are legitimate concerns. We've talked about that. Probably not immediately in 2022. This is going to wreak havoc on inequality. It is going to wreak havoc on poverty. And more importantly, it is going to wreak havoc on the gender gap, something we just don't talk about.
Yeah.
If you look at the manner in which this shock has filtered through the economy, it has been dominated by a decline in the services sector.
Yeah.
Services sector is the place where you have most women employment, and more women are employed in the services sector than the manufacturing sector. So the shock to women's labor participation, shock to women's employment has been significantly larger than that in that in manufacturing or male labor. Now, we don't have data on that, and therefore we don't talk about it. But in countries where we do have data, for example, in the US, if you just looked at the December job numbers, don't look at anything else. The December job number, the December jobs, total number of job loss was 150,000, of which 159,000 were women. And male employment actually went up by 6,000. So, and this gender gap is important, or the impact on female labor employment is important for the medium term, because we do know from previous shocks that when female labor employment gets shocked downwards, it takes a very, very long time for women's labor to come back to its original participation rate. And again, we don't have data in India, so we don't know what to talk about them. But if you look at data that in developed markets, where you do have the data, most of the increase in labor participation rate since the global financial crisis has come from higher participation rate in women's labor.
In fact,
so I think,
if I can just add one little nugget here, CMIE data, Mahesh Vyas has been arguing that if even from the demonetization experience, the women who dropped out of the labor force never returned. It was by 2019, it was a new cohort of younger women that were
right.
first-time entrants into the labor force rather than recoveries for women that dropped out. So that's going to be a significant issue.
And that has a serious implication of what we talk about in terms of India's growth potential in the next 3 to 5 years, right?
Yeah.
But before, even if we go to 2022 and 23, etc., just the fact that there is going to be that large of an income shock to household and SME, just that, means that somewhere in the second half of 2021, assuming that we do have a vaccination rollout that's successful, we add to the herd immunity, implied herd immunity that India has, so that by the second half of 2021, we have mobility back to normal. People are listening so that the government and corporate sector can go back to normal activity. The problem will be that what happens to these SMEs and households who will come to banks to ask for credit?
Yeah.
Because their balance sheets are going to be impaired very badly. Now, again, we don't see that in the data right now because we have a debt moratorium. We have the RBI, which Rathin talks about monetary policy. I think the regulatory easing that has been done by RBI and other central banks have been far larger impact than just the monetary easing that has been done. If you look at the regulatory easing in India, which has been extended, and even in the US is going to get extended. That regulatory, all of these regulatory easing, they have a limited shelf life. You can't ease forever. At some point in time, you need to go back and say, you know what, I need to go back to the old accounting norms, etc. The moment that happens, you are going to see NPL starting to surface in the Indian economy, and the RBI in its latest financial stability report is looking at a 16.5% NPL ratio in somewhere in 2021. If the shock actually hits through, I think that's a pretty reasonable number. Probably it's going to be higher than that. So the problem is the following, and this is where the permanent scarring of the pandemic comes into play, is that when India needs the credit growth, that's when banks are going to turn around and say, look, we already are coming out of a pretty bad capitalization problem already. We cannot go and extend our risk capital to a level where we are again going to go into another round of recapitalization. And therefore, there is a serious concern, at least in our heads, that unless fiscal policy is appropriately done, and this massive shock to labor income is mitigated, and there is still time to do it, even though the government hasn't done very much in fiscal year 21, India will face a problem that the fact that it chose fiscal rectitude in a year when every other country under the sun blew their budgets, they might simply be forced to do fiscal expansion through, let's say, bank recapitalization at a period when the rest of the world is actually consolidating and India stands out like a sore thumb. But more importantly, the balance sheet damage that can happen will scar medium-term growth. Apart from female labor employment, there is going to be scarring created by this. Medium-term growth falls. And the irony is going to be that it's medium-term growth that matters for rating agencies. You go back to, sorry, Rathin, you were going to say something.
And therefore, I think that it is very important to think out of the box on macroeconomic policy. And I've been arguing this for a while, that we have to take the share of wages in GDP. It's the only measure that I would like to be more granular.
Except that we don't have any measures of wages in GDP.
No, we can come up with a measure of wages because we do collect wage data. And we can collect it pretty effectively. We don't have employment data, so we have to assume something there. But wages times employment, which gives you the share of wage income in GDP, has to go up. If it doesn't go up with employment, it has to go up with wages.
Absolutely.
Which means that we have to see a period of lower profits. And not as we were thinking in the old-fashioned way, higher profits means higher investment, means higher growth. That game is over.
So just going back to the very near term, the question then in front of at least to us, in front of the government, this fiscal budget, and this is where I disagree with Rathin. Rathin made the argument that India does not have the state capacity to provide the kind of support that India needed. And I agree completely that if your entire push towards development is based on projects and not on policy, then obviously that will work only if you have a much larger state capacity. The reason why we want to do policies rather than projects is because policies are cut across. I mean, it cuts across everything. You do not need to monitor policy. Projects you have to monitor every day. So when you don't have state capacity, you go for policies. And the lack of state capacity should have meant that India should have gone for policies. And my point is the following, that we spent 4 years creating Jan Dhan Yojana with the Aadhaar stuff. We went and said that this was one of the biggest achievements, and it is a huge achievement to be able to cover that many number of people under Aadhaar and to use that as a cash transfer system. We created the Mudra Bank precisely to be able to transfer resources from the government to SMEs, from the government to households, without having to go through the usual rigmarole that we used to go through. We already had the machinery. All we had to do was to use that machinery. And I get it that there's going to be leakage. People are going to have falsified names, this, that, and the other. Even with the leakage, even if I discount the leakage, let there be leakage, right? You would still be able to have staved the damage that has already been done to the balance sheets of SMEs, to the balance sheets of households. And this is where I think the biggest concern is, that despite the limit, and I understand the limitation that, if you have a pandemic and no one can go out to work, how can you have capital expenditure? I mean, who on earth is going to lay down railroad tracks when you just you're not allowed even to go out and you have to have 6 feet of distancing and wear masks? I mean, you really can't lay down, railway tracks. I understand you can't do capital expenditure. I'm not a fan of pushing for capital expenditure precisely for this reason. And, and we can talk about it. I think the critical element is to shift to public health policy, but, that's a separate, we can talk about it separately. But I think just in terms of income support, and I think there is an enormous amount of reticence among us that you can't give out people money because without any work. Why you just can't give out handouts, right?
No,
And my point is,
yeah.
Before
yeah,
you come in, Rathin wants to jump in, but I did want to add on to what Jahangir is saying. In fact, the infrastructure exists, and what the government has done is the bare minimum. So it's deployed that infrastructure to the bare minimum that it needs. Whereas there's a lot more that could be done, because actually parts of our welfare architecture have proven extremely resilient at this point, and particularly in rural India. So in some ways you're making a case, or at least we interpret the way we want to. So I will interpret your case in the following way. Public infrastructure, capex, hard to do for all the reasons that both of you say. Social infrastructure in its own way has proved more resilient, may in the long term be much more important. And that's perhaps where expansive fiscal stimulus should be put. So if you do PMAY, the Awas Yojana, that has proven actually to be a well-implemented program. Narega has shown itself to be relatively more resilient. There is a fair amount of infrastructure that needs to be built even for public health, which can be done without getting into larger questions of quality of doctors. But there is an infrastructure gap that can be met. There is also a lot more on urban infrastructure that can be deployed quickly and fast. So perhaps that could be the route out, at least for this year.
Yes, if you use the governments of India.
I agree.
If your binding constraint is that I will do nothing, where the states and the municipalities and the downstream levels of government are engaged and involved in delivery, you will get toilets being used as godowns as you got in Swachh Bharat. Because the granularity of this country, whether it is an income transfer, other than putting money into people's bank accounts, you can go and do that till our kingdom come. But then you want them to spend it. So you have to create ways in which they can spend it creatively, right? You want Pradhan Mantri Awas Yojana, you have to deal with the land issue. You have to find the right kind of people buying the houses. All that requires the cooperation of state governments and their empowerment. Ideally a third tier, but our third tier is sclerotic. So I'm not even going there. Without that, the effect, as a fiscal economist, the effectiveness of public investment will be too low. And what matters, Jahangir, about the leakages, I don't mind handouts, but I don't want handouts reversing back into the hands of the very elite that is benefiting from this profit-led recovery. So if the government were able to come up with a spending battle plan at a sufficient level of granularity, I am very happy with that. And I agree with you. No. There is no constraint to financing a double-digit fiscal deficit whatsoever. So I completely
my issue with all of this is that, at the end of the day, policy making is to get your hands dirty, and you will be smeared by all of these things. But let's not the best be the enemy of the good.
Absolutely.
I would love to have a way of transferring cash that has no leakages. And I will make a cop-out excuse saying that we really do not have the luxury of waiting to build such a system before spending. I think we need the income support now. And what our view is that if we don't have that now, then second half of 21, forget about 22, 23, 24. Second half of 21 is at risk.
My disagreement with you is not on the diagnosis at all. My disagreement is that it is one thing to say that you will allocate money for income support. It is quite another to provide it. And that gap cannot be too large. And therefore,
right, but I'm saying that the provision can be done through existing transfer systems, and there is going to be leakage. I am conceding there's going to be leakage, but let there be leakage. Let us accept it. For the time being, let's accept it, that there will be leakage. But if we don't provide it, I think we are getting ourselves to a position where just because we don't see it, and here's my problem, Rathin. We don't talk about the impairment of balance sheets because the RBI just told banks, you don't have to show anything. And it is going to hit us suddenly. One fine day, RBI is going to lift that thing, and almost the very next day is going to hit us. And that's where my concern is. But on a separate issue, I think where I think it matters is that, there is all of these things that, we talk about in terms of, the lack of fiscal space. And I'm going to go back to it because I think it is an important point to clarify that, Indian, as Rathin pointed out, look, from 2013 was the last time when we actually consolidated the budget. The only reason we did that in 2013 because there was a taper tantrum. Let's face it. The moment the taper tantrum was over, we went a merry way of spending. Every year we have spent not only on the budget, we have shifted. All the bad habits have come back, and we have gone off budget. And then if you look at the total public sector's deficit, that has continued to grow, despite the fact that India's growth rate had been 8%, 6%, 4%. Total public sector spending deficit had been the same. And I'm not denying that. The problem is that when you look at that and you look at India's fiscal deficit, overall public sector fiscal deficit around 11% of 13%, 13% of GDP. You look at that, you look at the debt stock, and you look at these metrics which have been, essentially, decided by whole bunches of people, and we've kept on following it. But all of these metrics are simply cookie cutter metrics. They have to be calibrated to the situation that you're facing immediately. And so let's go back to the second quarter calendar year. Right? The quarter in which India's growth plummeted 24% on a year-on-year basis. That was the year, and that was the quarter in which current account surplus went up to 4% of GDP. We run about -2. We were running 4. As Rathin pointed out, 4 is going to come down, but we're going to average around 1.5, 2 for the fiscal year 21. So we move from -2 to +2. Now, usually current account is typically seen as, well, that's the difference between exports and imports. In reality, that is not what it is. Exports and imports are simply manifestations of that. In reality, it tells you what is the total amount of savings that Indians have, what is the total amount of investments Indians do, and what is the gap between the two of them. The gap between the two of them is what you borrow from abroad. And that is your current account deficit or surplus. So if your savings are more than in the case of investment, which is the case in the case of China, you lend money abroad. And you run current account surpluses. If your savings is less than your investment, then you borrow from abroad, and that turns out to be your current account deficit. So here is a narrative. Forget about JP Morgan estimate, etc. 2021, India is going to have its worst growth ever in the last, 100 years. That year, the government could not provide sufficient amount of fiscal support because of the lack of fiscal space. Right? That's the narrative. In the same year, Indians actually went and, instead of borrowing from abroad, lent to foreigners.
Yeah.
The Reserve Bank, and a manifestation of that is that, well, one arm of the government, North Bloc, is telling us, I don't have any revenue to spend. Another part of the government, agency of the government, called the Reserve Bank of India, went and invested in this fiscal year. I'm not even going from January of 2020. In this fiscal year, about $80 billion, mostly in US treasuries. So, well, India could not fund its own, could not support its own economy through higher spending. It did support the US fiscal spending by providing funding for that fiscal deficit. That's the irony of the situation. It isn't that we do not have fiscal space. We have fiscal space. We should have used that fiscal space. We did not use that fiscal space. Instead, we used that fiscal space to lend to foreign countries, mostly in the form of US treasuries. That's what we did. RBI not only bought government of India treasuries, RBI also bought US treasuries. And I think this irony...
That only reinforces my point. My point is that the state capacity, especially the fiscal capacity, you said policies. I agree with you. Other than spending money, which I think the problem is fundamentally the government of India is unable to expand its public spending with the best will in the world. They don't want to admit it, but they have not the instrumentation. But there are many things you could do in terms of policies, I completely agree with you, which do not in fact cost money and which may actually enable you to make transfers, right? That's what you're saying.
Yes.
You want money to be transferred. Transfer is not difficult to do. You need policies to make transfers. And we have not been able to do that because traditionally the instrumentation by which you make these transfers till this wretched Jan Dhan came in was to state governments. So instead of making the state governments borrow if they had been given massive grants and aid and asked to spend them, and that could have been reflected on the government of India's fiscal deficit, you would have got much better transfers. But the political Faustian bargain this government has made is thou shalt not get credit for addressing the pandemic with the state governments. And that Faustian bargain is going to cost us.
So without going into the Faustian deal part of it, my point is much simpler. My point is that the metrics that we use to look at all other crises is not the metric that we need to use in this crisis, because this crisis is different. And if you look across the world, Yamini, Rathin, it is not a case of India. Every emerging, all those taper tantrum countries, the fragile five, every one of them, if you look at the current account deficits, all of them, the current account deficits have all plummeted or have turned into current account surpluses. And it's the same thing, which is that when there is a shock to the economy, there is excess savings. Now, in the case of India, unfortunately, the excess savings is going to be in the corporate sector, whereas the households and the SMEs are going to have negative savings because they are going to basically live off the savings, which is where the balance sheet impairment comes. But I think that my point being that whatever's happened in 2020 has happened in 2020. Let's look forward in 2021. In 2021, in February, if the government continues to go and say that, look, I'm going to follow the path of straight and narrow, whether it is a policy choice or it is a choice forced upon, as far as Rathin's framework is concerned, forced upon by the political economy, doesn't really matter. When the choice is made is that we are going to go back to the straight and narrow, then I think, and going to the straight and narrow, if it also involves doing things like, which I'm hearing in news reports, etc., that there will be a special COVID-19 cess, or there's going to be an increase in taxes, right? I think this is going to have serious medium-term implications. There is, even if you don't believe our numbers that India's growth is going to go -6.5% to 13%, even if it is somewhere in between, right? There is going to be a massive reversal of the plummet of the decline in revenue that took place, simply because the economy is growing. India's revenue is going to expand. The question is, what does the government do with that revenue? Does the government say that the entire improvement in revenue goes to bringing down my deficit, or do I use part of it to bring down the deficit because I have to show that I'm bringing down the deficit? I understand that. And the other half goes to providing both income support, and I would argue that the only other place where India should even bother about infrastructure spending is the topic that no one seems to be talking about, which is public health.
Absolutely. Thank you, Jahangir. We're nearing the end of this discussion, but Rathin, I wanted to just ask you, you've been, if we were to go with, take what Jahangir is saying to his logical conclusion, mapping onto what you've been saying, that the only appropriate way of doing this is by strengthening the role of states. We also are going to be, the budget will also be presented against the backdrop of the 15th Finance Commission report, which is going to take an important view on the trajectory of devolution and the nature of intergovernment fiscal transfers. So your thoughts on that combined, is this an opportunity that the budget could sort of build on to at least ensure a steady path to fiscal devolution? or how do you see what that combine is going to do?
Well, if you take what I'm saying seriously, what I'm saying is that if the central government tries to sort of clown around any further, trying to spend more money, it cannot. You have to go to North Block to see that. There is no instrumentation. There is no instrumentation down there. What the Home Ministry can do, because it has a police force and issue orders. The Finance Ministry, with great respect, is not the Home Ministry. It does not have the instrumentation to get down there where it is needed. The public sector banks are put to purposes that were not intended in 1969. It's too late to go into that. And therefore, that instrumentation is not available. You have destroyed your post office banking system. You simply do not have that kind of spine going from the imperial capital, from Delhi Sultanate, as a certain gentleman once called it, down to the state level. Therefore, the states have to be empowered. So what better case can I make to increase tax devolution to the states at once and to give them primacy in increasing borrowing, especially given what already exists, that before this pandemic started, states taken together were, broadly speaking, not running a revenue deficit. They were okay. So if you put your bets at the state level and focus on enabling policies, then that will work. If the central government insists on trying to spend more money and not being able to do it, then all I would say is, please quadruple your salary payments to central government employees, quadruple your workforce with my blessing. They cannot even build an All India Institute of Medical Sciences anymore. They cannot even build an IIT anymore. They cannot even build an IIM anymore. This has got to be understood. The biggest threat to fiscal prudence in our country is pretending that we are building things which do not provide returns. The returns to that are extremely perverse. I think there are limits to the transfer money business. Unless we really seriously invest, I'm opposed to it, but now I've given up. Now we are not a significant economy with a growth story anymore. Let's have a universal basic income. Because my only objection to that is that, if you have a growth story, you don't need one. Now we are not a growth story. Fine. If we can do that and roll that out, and if there's something like that in the budget, I'd be the happiest man in the world. But with the existing instrumentation, increasing effective public spending, I'm afraid, has limited scope. And therefore, I think very much, irrespective of what the Finance Commission report says, the states are where I would put the money, as if I'm putting the money on a roulette board. Unfortunately, I have to repeat this, the political economy of the present day is not to give credit. It is to suck it out of the states. We are back to the early 1980s, and we chose to be here. Thank you.
Thank you, Rathin. Thank you, Jahangir. This has been, as was expected, an extremely provocative and a challenging discussion. I think you've pushed us to think differently, and I think.
Yamini, just before you go to Q&A, I just want to make 2 minutes my pitch on public health. Look, I have no understanding of public health. What I have is a vague understanding of FDI. Now, think about the way in which people are thinking about public health is because, well, look, it's a once in a lifetime shock. It's not going to happen again, right? But we really want FDI to come in. Mm-hmm. And the way in which we're thinking about the FDI framework is the same way we thought about the FDI framework in the 70s, 80s, and 90s. That you want to come into India, why? You want to come to India because of cheap and skilled labor. You want to come because of ease of doing business. You want to come to India because of its huge market. The problem is that the pandemic changed all that. You no company is doing very much FDI in the first place. But let's say in a year times we are back to where we normalize things. When the FDI comes in, it is not just going to be seeking cheap labor. It is not going to be seeking, ease of doing business. It is going to ask the question, what is the state of your public health? Why? Because so far in India, we have managed to make the argument that, look, we have a pretty bad public health system, but don't worry about it. Our private health is exceptionally good. Not only is it exceptionally good and world standard, it is actually significantly cheaper than the rest of the world. So what are you bothered about? What this pandemic showed is that private health is not a substitute for public health. And if public health falls apart, then there is nothing private health can do. And this lesson, at least for the next 5-6 years, is going to be paramount in every FDI investment. Remember, FDI is not just about bringing in machineries and technology. It's about bringing in people. Can you really imagine people moving from one country to another country with their children, with their family, etc., 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 when the memories of the pandemic are still so fresh? So I don't think this is just a question of, fairness, and that we should have, that the poor who didn't get access to private health should get public. All of those arguments are the right arguments. I'm
And
not
there's a
even going down
macroeconomic reason why I think your emphasis is very important. It does what I want it to do. It changes the output composition of demand.
Yes,
We get more
absolutely.
demand from healthcare and less from cars, and that's where I want to go.
No, absolutely. I think that we've always thought of investments in human capital as something that will happen eventually. But in fact, investments in human capital are constitutive of growth, not a consequence of growth. And that's the most fundamental shift that we need to make. I fear, though, that in our response to a public health response to the pandemic, we are now in a phase as a country where we think that investments in our vaccine infrastructure is going to resolve the big challenge of investments in core public health. And that means investing in primary healthcare. It means investing in the governance and surveillance ecosystem, the epidemiological ecosystem that builds into the primary health system. And we are quite far away from that. Yet, I think you make a very important macroeconomic argument, both of you, for investments in core public health, for investments in income support and cash transfers, which lie at the heart of the pandemic response. And also, I think, lie at the heart of the unemployment challenge, which is at the center of what I think this budget should be thinking about, to at least get us onto a path that will put us back onto growth, positive growth going forward.
May I answer the last question there?
Yes,
so, Mr. Jain, there is no slow burn of consensus.
Wait 1 second. It would be fair to everyone for me to just quickly read out the question before you answer it. Recent insights on the economic history of India suggest that big change happens when a slow burn of consensus builds up around policy issues. In the panelists' opinion, such a consensus being built up around the key concerns they identified.
Oh, you seem to have a lot of plurality of consensus on many things. Regrettably, the one place it is conspicuously absent is the economy. You have a plurality of consensus on building statues. You have a plurality of consensus on making states union territories. No? You have a plurality of consensus on getting insulted about various religious matters. And you have a plurality of consensus, if you like, on love jihad. I didn't say you have a full consensus. I think slow burn is a very appropriate term there, Mr. Jain. I really wish that some of that energy could have been deployed both by government and by society into getting more of a consensus on the issues that this pandemic is going to bring to us, which is a more unequal, more disempowered, weaker economy, which requires urgently consensus to do things beyond business as usual.
Thank you. On that note, thank you very much, Jahangir. Thank you very much, Rathin, and look forward to perhaps coming back post the budget to see whether any of what we've discussed finds its way in and what the future holds for the Indian economy for FY22.
I'll make a prediction, not a chance.
I thought, Rathin, you don't do predictions.
No, today I will, because I'm now so confident about the incapacity of this government to absorb sensible strategic advice that I will say not a chance. You might get all this cess, you might get some Deen Dayal something, but not a chance that you'll get, organized, systematic thinking.
Well, we'll hold that for February 2nd. Thank you, Jahangir. Thanks, Rathin, and thanks all of you.
Thank you.
Thanks, everyone. Bye.
Thank you.